Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So British Petroleum, we've got this leak in the Gulf. They're going to be on the hook for something. Could be a real problem for that company. And just to put it in scale, for those of you who haven't heard this comparison before, BP's market cap is about 5% of the UK's annual GDP as of 2008 numbers. So things that happen to BP kind of happens to the UK's economy in general, which does not bode well for the currency for sterling. So if the pound were to continue to weaken, we could see a break here of where the markets have kind of stopped. So we're stopped at about right now we're about 0.69 pounds to the dollar. So we could see this continue to move up quite a bit, and it has been moving up a lot. And there are ways that we can take advantage of this. Now, I mentioned before that I wanted to propose a couple of ideas as to, as long as we're thinking about profiting from or hedging against some of the uncertainty out there, or, by getting some exposure to currency options, how do we minimize, one of the reasons why we would find that so attractive is that, we have all this uncertainty in the market. And the problem with that is that uncertainty is driving up option prices, so it makes it more expensive and more risky to be trading long options where we can get some of that big upside potential. So here's another way. When we were looking at YUK, I suggested, well, we may want to even take an even more speculative position that's got lower time value in absolute dollar terms with an out-of-the-money position. Well, what about an in-the-money position? So let me give you, for instance, here. Let's say that we were to look at calls on BPX, something that was at the money. So let's say 69.50. We're almost at exactly 69.50. So the 69.50 calls expiring in July right now cost $180 a share, or $180 a contract. Now, what happens? So I think most option traders are familiar with the way that volatility works as you go further in the money and out of the money. And one of the things that we can do to try to reduce the disadvantages of this amplified volatility is we can move further in the money. So let's say, for example, that rather than buying the 69.40 calls, we were to go $5 in the money, all the way down to 64.50. So down right here. So we would be in the money quite a bit, and that option is going to be more expensive in absolute dollar terms. It's going to cost us more. In fact, when I priced this particular option earlier today, it was at about $550 a share, or $550 a contract. But keep in mind that there's two components to option prices. There's intrinsic value, of which, so if we're $5 in the money, that means we have $5 of intrinsic value. And there's also extrinsic value, which, it's time value, right? It's that premium that's added to the options price. How much extrinsic value do we have, or that melting time value do we have in this at-the-money option? We have $1.80 worth. But how much do we have with this in-the-money option? With 50 cents. So in both as a percentage of the total premium paid as well as absolute dollar terms, we suffer a lot less from melting time value and inflated volatility levels like we're dealing with right now when we go further in the money. Now, it does increase, obviously, it increases the cost of this particular option, but or I should say that the price of that option. So we have to think about how do we position size to make sure that a small move here that turns out to be a loser doesn't completely slant our portfolio towards this, if this position doesn't work out very well. So we'd want to make sure that we're evaluating how do we think about that position sizing and make sure that we're not getting in too heavy. But it is one of the ways in which, if you're determined to be trading options, long options, so we can, make sure that we have that limited risk, one of the things we would want to do is to go where that time value isn't going to hurt us as much. And one of the places we can go to do that is going to be in the money. And it's one of those things that I find that shorter-term option traders or, especially in the currency options world, they don't automatically think about that because of the cost of the option. And so they tend to kind of look for even those out-of-the-money strike prices that are more speculative but much cheaper. So it is one of those things that changes the paradigm or the way in which a lot of option traders think about speculating in the market, but maybe very appropriate, and you have all that flexibility to be able to handle that today. So the bottom line is, if things get worse with BP, and we currently have no idea how much worse it could get a lot worse, it's going to affect the UK, and they've got pressure coming from the other side, from the continent, with problems in Europe. And the UK's economy, although they have the advantage of controlling their own currency, they're exposed to those same risks that Europe is, and probably to a much greater extent than the dollar. So we have, on the one hand, these problems out here with BP that could have a small impact on the value of the currency. And on the other hand, we have a much larger looming issue of the European crisis bleeding over into the UK, which is further compounded because traders are moving into the dollar. So the pound could further weaken because of a strong dollar, a weak pound, and potentially problems in the oil business. In fact, overall, the pound from time to time can be very correlated to oil prices in general, not just BP, but oil prices in general. And so if we continue, so we've got another factor kind of piling on here with if economic growth around the globe in general begins to slack off a little bit, that would further compound some of the problems. I know that sterling isn't, or the pound isn't generally considered a commodity currency, but oftentimes it can act very much like one. So if demand for commodities in general, and oil, energy commodities, continues to slack off, that would impact the pound. So, as we have this opportunity, we think, all right, well, I'm going to buy a break of, where the market's got. So 70.25. The market gets up above 70.25, let's say 70.75. I'm going to buy a call of that position, but I'm going to buy an in-the-money call so that I don't have to worry so much about that time value premium melting away so rapidly and so much of it. And this example, I think, is a pretty good illustration of exactly how bad is that time value and how can we make it better. So what can we do? What are the options available to us to make it a little bit more or less damaging, I should say.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.